Hello friends, welcome to learning sessions, and this is the class number 12 for the ABFM, and we are covering the module B, right? And in module B specifically we are covering the chapter number 8, that's related to the financial leverage or trading on equity. So do confirm the audio quality at the earliest, and this is a part 2 related to the video, and we were covering the topic previously that was related to the what is the difference between the EPS or how the EPS changes when the composition of the debt and equity changes, right? And also if the EBIT is basically altered for the same. So we basically learned that particular concept, and after that we are moving toward the next part, and it's related to the some of the uh, issue or some of the let's say we are going to learn the points related to the fifth point over here. So let's pay attention to what it. So it's about the question 5, we can say. So let's have a look over here. So it says specifically that the XYZ company has currently an equity share capital of rupees 40 lakh, consisting 40,000 equity shares and 100 each. The management is planning to raise another 30 lakh rupees to finance major program of expansion through one of the 4 possible financing plans. The options which are available, like we can basically be raising entirely through the equity shares or rupees 15 lakh in the equity shares of rupees 100 each, and the balance in 8% debentures, right? So the company says either they can be issuing the 15 lakh of the equity shares, right? Or basically what we'll be doing, sorry, in the first scenario, they are going to issue 30 lakh of the equity shares, or the second scenario, they'll be like issuing 15 lakh, like 50% of the equity shares, and 15 lakh they'll be raising through the debt, right? And in the third scenario, they are saying that 10 lakh equity shares and further the balance through long-term borrowing, that 10 lakh through the equity shares plus 20 lakh through the long-term borrowing, right? And the fourth scenario, 15 lakh equity shares and the balance through the preference shares with 5% dividend. Like 15 lakh would be related to the ordinary shares, and the another 15 lakh would be related to the preference shares. So this is the composition which is given over here, and how it's going to work out for them. We are to basically uh, comment upon it. We are to comment upon it. Clear with it? So the first part here is total equity. It's basically the entire equity composition. Entirely it is going to be the equity. And the second plan, it's like 50% equity and 50% the debt is present. In the third plan, it's like the 10 lakh, almost the 33% is equity, and the another 67% is around the debt, right? And the fourth plan, it's like 15% equity, 50% equity, and the 50% from the preference shares. So it's the ordinary shares and plus these are the preference shares. Okay, and the company is basically expected uh, EBIT will be 15 lakh rupees. The EBIT is given to be 15 lakh rupees, and we have to assume the corporate tax rate of 50% for this scenario, right? So let's have a look at this particular table now. So we are having the different plans: plan 1, plan 2, 3, and 4. And equity shares, if we look at, like, for the first case, for the first case, like we are already having the 40 lakh of the shares. It's already given in the question that the company is basically currently equity capital of 40 lakh rupees, and 40,000 equity shares have already been issued, right? So 40 lakh equity is already available with you. Okay. So 40,000 shares were already available, and you will be issuing another 30,000 of the shares. So total it will be like 70 lakh rupees of the equity shares or the capital will be available. And in the second scenario, 40 lakh is already existent, and further you will be issuing 15 lakh of the another equity shares. As per the fourth plan, the you'll be basically be having the 40 lakh already and 10 lakh another, and the fourth plan it will be like 40 lakh already and 15 lakh in general shares, right? So total 55. So equity share would be numbers. If we look at the numbers, like the previously we were looking at the amount, but now we are looking at the numbers. So the number of the shares is like 70,000 in the first case, 55,000 in another, 50,000, and then 55,000, because it's like each share is valuing 100 rupees, right? And if we look at the debentures, like the debentures are issued in the one plan only. That's a plan number 2. That's only related to 15 lakh of the debentures were issued at 8%. And the long-term borrowing was done related to 20 lakh rupees in the plan number 3. And the preference shares with the fixed dividend of 5% were issued in the plan number 4, right? So that's a part. So EBIT would be what? EBIT is given same. Like that's already given in the question that EBIT is 15 lakh rupees. In all the cases, it is 15 lakh rupees. Now, if there is any interest cost, we have to deduct that. That will be there in case of the debentures, because 8% over 15 lakh rupees, we have to calculate, that's 1,20,000. And for the 9% over 20 lakh rupees, in case of the long-term liability for the plan number 3, it is 1,80,000. So this is to be deducted. This is to be deducted, and also this one to be deducted from the EBIT so as to calculate the EBT, that is earning before tax. So here we calculated the EBT, right? And that came out to be like 15 lakh, because there is no deduction in the plan number 1, and plan number 4 there is no deduction. For the plan number 2 and plan number 3 there was deduction. So we basically got the EBT, and we are given the corporate tax, that is given to be 50%. That's already given in the question. Corporate tax of 50% is given. So we are to deduct 50% of the tax. So we'll be having the profit after tax PAT, that is 7,50,000 in the first scenario, 6,90,000 in the second. In third scenario, we'll be having 6,60,000, and fourth case will be having the 7,50,000. This is the EAT, earning after tax, or we can say it to be PAT, that is profit after tax. Understanding the points so far? So this is how we just calculated the points. So this is like what we calculated, what we used to do. So we were given the EBIT. So from EBIT, we are to subtract the interest. We'll be having the EBT, and further we subtracted the taxes. We'll be having the profit after tax. This is what we did so far. Okay. Now, if there is any preference dividend that is to be deducted, yes, that was the plan number 4, because we are to pay 5% of the fixed dividend. So that is to be deducted. So for the equity shareholders, the earning that will be available, that will be this. This point is basically indicating the earnings which is available, and the number of equity shares. We are already having the number of equity shares that basically stated in the row number second. And so the earning per share can be calculated now, like 7,50,000 divided by 70,000, that's 10.71 around for the plan 1. So this is a plan 1 where the EPS is 10.71. For the second, third, it is 13.20, and fourth, it is 12.27. So you can now be understanding that the EPS basically increased when the debt amount increased. So in the third scenario, the debt was 20 lakh rupees of the debt. In the second case, it was 15 lakh of the debt, right? So when you increase the debt, when we basically increased the debt, in that scenario, the financial leverage also increased, and the highest EPS is in that scenario only. So best financial plan is related to what? Like 10 lakh of the equity was there, and 20 lakh of the long-term borrowing was there. And what is the reason? Like, because the debt financing basically increases the return to the equity shareholders, right? And the lower number of equity shares are there, and the maximum tax advantage related to the interest that you paid upon the particular debt, that is taken. So that's why the EPS increased in this particular plan appropriately. Okay, so that is the case. Getting it? So that we can get an idea that if we do increase the debt composition, that is going to do what? First of all, the equity shares are basically limited. That's the first point. The equity shares are now limited. And the second thing, it's about the tax advantage that's available. The tax advantage that is available, because when you pay the interest upon the loan amount, that is a deductible expense, right? So you get the benefit also. So the earning per share overall increases. Clear with it? After that, the next topic, it's about the operating leverage. The next topic that we are going to cover, it's the operating leverage. Now, operating leverage measures the effect of change in sales on operating profit. Like the effect of change in sales. If the sales do change, right? Sales do change. So what will be the change on the operating profit? On operating profit, what will be the change if we do change the sales, right? Because the fixed operating costs are there. So we do assume that the fixed operating expenses are there, except the interest, and further then we correlate this to profit. Like if the sales are changed, how the operating profit will change. So operating lever measures the sensitivity of the company's operating income to that given change in the sales. Okay. So the key concept is like a business with higher fixed operating cost is having the higher operating leverage. Okay. So the concept is what? The concept is like if your company is having the higher fixed operating cost, we are concerned about the fixed operating cost. So higher the fixed operating cost is, higher is the operating leverage. More operating leverage will be available with you. It means that the operating risk arises due to inability to cover the fixed operating cost. Operating risk arises what? Like let's say if you're having the very high fixed cost, you're having the high operating leverage. And if you're having the high operating leverage, you'll be having the higher business risk also. So let's say if I'm running a cafe, let's assume I'm running a cafe, right? And further, my friend is also running a cafe. So here are the two persons, person A and person B. Now, the fixed cost for the cafe A person is 5 lakh rupees per month. The fixed operating cost that whatsoever there is, like even if we don't earn a penny, we have to pay rupees 5 lakh, right? But for the second case, it is 30,000 rupees only, right? So which one is more riskier? So if we are able to cover 5 lakh rupees, then it's okay. But what if for 1 month we are not able to cover the expenses? The A cafe will fail, right? So that's about it. So more is a operating, basically, let me just give you the idea. So here it is like given also like high fixed cost. If you're having the fixed costs which are higher, that will be leading toward what? That operating leverage will be higher. And if operating leverage will be higher, the business risk will be higher. That's the major point that we need to understand. Okay. So what is business risk or operating risk? What is the business risk or the operating risk? That's basically the inability so as to cover the fixed operating cost. I already told you. Okay. Now let's have a look at the features of the operating leverage. Features of the operating leverage. First thing, it is related to the fixed cost. It is related to the fixed operating cost. Like that depends upon the fixed operating expenses. And it measures what? It measures the sale profit relationship. Sales profit relationship, the operating leverage. And basically, higher leverage means higher risk. It gives rise to the operating risk or the business risk. So higher leverage means higher risk. And definitely it is higher in the manufacturing firms because there is large fixed asset base. It's higher in the case of the manufacturing companies. Huge amount of the fixed operating costs are there. Okay, getting it? So these are the features. The first one, it's related to, it's concerned with the fixed operating cost. And further, it measures the relationship between the sales revenue and the operating profit. And it gives rises to the operating risk with the business risk. Clear with it so far? Now, after that, let's have a look at these formulas. I have already told you about the contribution. Contribution is equal to what? It is equal to sales minus the variable cost. And what about the operating profit? It's about the contribution minus the fixed cost. That's your operating profit is. Contribution minus the fixed cost. And contribution is what? It is sales minus the variable cost. So if you deduct both the costs, like from a variable cost and the fixed cost from the sales, you'll be getting the operating profit. And what is the operating leverage? It's like contribution divided by the operating profit. That's the operating leverage. That is a degree of operating leverage. And PV ratio, like if the question comes related to PV ratio, we have already covered. It's fixed cost, sorry, it's contribution divided by sales. So we are having another formula related to the contribution, that is PV ratio into sales. And what is the formula related to break-even point? I already have given the formula to you related to the break-even point. Like the another formula related to the break-even point. What was that? Fixed cost divided by contribution. Fixed cost divided by the contribution. And also you can be rewriting it as fixed cost to the PV ratio. Okay, so at the break-even point, the fixed costs are fully recovered. Fully recovered. Like first of all, we do what we do, calculate the contribution margin. You're basically having the you're selling the product at rupees 10 and the input cost is rupee 8. That's a variable cost, right? So the contribution margin is rupees 2 and you're having the fixed cost of rupees 5,000. So 5,000 divided by 2, that is 2,500 units I'm to sell. 2,500 units I'm to sell. Then I'll be reaching out no profit, no loss situation that we have already covered in the last video, right? Right. So let's have a look at the this particular formulas. So company or a firm which is basically operating with the high degree of operating leverage and further above the break-even point, that is going to earn good number of profits. So it is operating with the high degree of operating leverage and that is earning basically above the break-even point, that earns good number of profits. And percentage change in sale will be equal to the percentage change in profit in that scenario. That is very much important to understand. After the, let's say, we can say operating leverage, the percentage change in sale will be equal to the change in the percentage change in the profit. And if the fixed costs are there, the percentage change in the profit will be more than the percentage change in the sales volume. Very important, very important. Like we have to pay attention to what these points. So if the firm is basically is having a high degree of operating leverage formula was related to what? Anyone? Operating leverage formula, contribution to the operating profit. Contribution to the operating profit. That was the formula, degree of operating leverage, right? So basically company which is having the high degree of the operating leverage and further it is above the break-even point, that will be earning the profit. Second thing, percentage change in sales will be equal to the percentage change in profit. But if the fixed costs are there, then the change in profit, percentage change in the profit will be more than the percentage in the sales volume. Okay. So the degree of operating leverage is basically equal to what? It is basically the profit, change in profit to the change in sales. Change in profit to the change in sales. Okay. So we are given with the data over here. Fixed cost is given to be 50,000. Variable cost is 70% of the sales. Sales is 2 lakh rupees in previous year and 2 lakh 50,000 in the current year. Find out the percentage change in sales and operating profit. First case, then when the fixed costs are not there. Second case, when the fixed costs are there. So when the fixed cost is not there, it is said to be the no leverage situation. And when the fixed cost is there, it is said to be the leveraged situation. So let's understand it. So first of all, let's understand it for the first scenario. First scenario. So if we just look at the sales, in the previous year, we were having 2 lakh of sales and now we are having 2 lakh 50,000 of the sales. So the percentage change in sale is equal to 2 lakh 50,000 minus 2 lakh divided by 2 lakh. That is 25% of the change in the variable cost. That's 70%, 1 lakh 40,000, 1 lakh 75,000, 25% change is there. profit from operations, like 2 lakh minus 1 lakh 40,000, that is your profit, right? That is basically 60,000 in first case, 75,000 in the second scenario. That is 25% change is there, right? And further, now we are considering what? That sales are given and the variable cost is given. For first case, we considered like when there is no fixed cost, no fixed cost. And when there is no fixed cost, there is no leverage, right? Same change in both the scenarios. Even if your sale change, there is no change. But when the fixed cost is there, fixed cost is there, that is basically added. Now the sales were 2 lakh rupees in the previous year, 2 lakh 50,000 in the current year. Variable cost 70%, we subtracted. And in the second case, in the first scenario, we basically got the contribution 60,000. In the second scenario, it is 75,000. But the fixed cost is like we are considering 50,000 of the fixed cost, right? So profit from operation is 10,000 in the first case and 25,000 in the second scenario. If we look at the percentage change, if we look at the percentage change, in the first case, the percentage of the profit from the operation was just 25% and the change was not there. But in the second scenario, profit from operation basically is now increased when the fixed costs are there. So if you just look at the points that we just understood above, that when the fixed costs are there, look at this particular point, that if the fixed costs are there, the percentage change in profit will be more than the percentage in sales volume. That's basically we say to be the operating leverage. That is what we say to be the operating leverage. Okay. So the positive effect is that if the sales do increase and if you're working above the break even, then it is going to magnify the profit. The positive effect of the operating leverage is this. Positive effect is what? It is going to magnify the profits if you're working above the break-even point. But the negative effect is what? Negative effect is this, that falling sales magnify the losses. Like if the sales are, negative effect is that, let's, if the sales are decreasing, then the losses do magnify. Then the losses magnify, right? Clear with it so far? So that's the point related to it. I hope that you must have understood the point so far. It's quite an important one. Clear? And after that, we are going to learn about the composite leverage and the combined leverage. It's about the composite leverage and the combined leverage. Very important again. Now, composite leverage, as the name suggests, we are going to combine both the financial leverage and the operating leverage. Both are to be combined. So both effects are to be combined so that we can do magnify the revenue of the firm. Like we have to combine the operating leverage, we have to combine the financial leverage. So it basically measures the sensitivity of the EPS due to change in sales. Now in the financial leverage, we are talking about the EPS. In operating leverage, we were talking about the sales to profit percentage change. If you remember, right? So the composite leverage or the combined leverage, we are going to talk about that the sensitivity of EPS, that how sensitive would be the EPS. Like if the sales do change, what will the impact on the EPS? It's going to represent the combined effect of the fixed operating cost and the fixed financial cost on the shareholders' earning. So the fixed operating cost is going to give the operating leverage, fixed financial cost is going to give the financial leverage. And in the case of the composite leverage, we are going to combine the effect of both. So operating leverage is due to the fixed operating cost, fixed costs. And the financial leverage is due to the fixed financial cost. Right? And in case of the composite leverage, we are going to combine the effect of the both. Both are to be like covered together. right? And what is the formula for it? What is the formula? It is quite simple. Like we are to look at the differences of the EPS to sales. So what will be the impact on the EPS for sales? So if you just memorize the basics, you can be memorizing the formulas very easily. So this is EPS to sales. And the very simplest formula that may be asked in the question also, that's the operating leverage into financial leverage. Degree of operating leverage to the degree of financial leverage, the multiplication of the same. That's it. So let's have a look at the question. So DUL is equal to what? DUL, degree of operating leverage. That's basically the contribution to EBIT. Contribution to EBIT. And what is the degree of financial leverage? It is EBIT to EBT. EBIT to EBT. And what will be the degree of combined leverage or composite leverage? Like it will be contribution divided by EBIT multiply by EBIT to EBT. So EBIT cancelled each other. So it will be contribution to EBT. This is the combined leverage. This is the combined or composite leverage. So companies having the sales of 5 lakh, variable cost 3 lakh, fixed cost 1 lakh, long-term loans 4 lakh at 10%. Calculate the composite leverage. Composite leverage we are to calculate, right? So if we are to calculate the composite leverage, the contribution is equal to what? It is sales minus the variable cost. That's your contribution. That's a contribution. The operating leverage would be equal to what? Contribution to EBIT. And what would be equal to the EBIT? EBIT is equal to sales minus the variable cost minus the fixed cost. That is your EBIT. So easily we can be calculating. So it is 2 lakh over 1 lakh. That is 2. And if we have to calculate the financial leverage, it is EBIT to EBT. EBIT already we calculated to be 1 lakh. And the EBT would be equal to what? That is sales minus the variable cost minus fixed cost minus the interest. And interest we can be calculating like long-term loan 10%. So 40%, 40,000 of the interest is being paid. So 1 lakh minus 40,000, that is equal to 60,000. So it is 1 lakh divided by 60,000. This is the financial leverage. And what will be the combined effect? That is 2 by 1 multiplied by 5 by 3. That is 10 by 3. So this is the combined leverage that we calculated. This is the combined leverage that we calculated to be 3.33. Right now, sales, if the sales do increase, if the sales do increase, the degree of leverage will fall. The degree of leverage, basically that will fall. Why? Because fixed costs are the same. But let me just tell you, if your DCL is higher, degree of combined leverage is higher, in that scenario, higher the DCL is means higher the risk which is associated with the business. And low DCL will indicate what? That indicates the lower overall sensitivity. Lower overall sensitivity in that scenario. So higher the DFL, higher the DUL, higher the DFL, risk is very high. Higher the DUL, lower the DFL, risk is normal. Lower the DUL, higher the DFL, risk is normal. Lower the DFL, lower the DUL, low risk is there. Getting it? So if we do compare the operating leverage and the financial leverage, what is the meaning basic first of all? So operating leverage is basically the ability to use the fixed operating cost so as to increase the returns. That how we do use the fixed operating cost so as to increase the returns. And the financial leverage is basically the ability to use the debt capital so as to increase the returns, or the fixed debt cost so as to increase the returns. That's the financial leverage. And further, It is related to just about the fixed cost of the firm. And the financial average is about the capital structure, that what is the composition of debt and equity. And further, it measures the operating costs, operating risks, right? And it measures the financial risk of a business. Calculation is very simple. Contribution to EBIT, and EBIT to EBT is basically the degree of financial leverage. And if we look at the impact, if the degree of operating leverage is higher, higher is the business risk. Higher is the business risk. So it basically depicts the operating risk, and higher the DFL, higher is the financial risk. And further, like the degree of operating leverage is usually higher than the break-even point. It's usually higher than the break-even point, right? And further, if you look at the financial leverage, it is having the direct relationship with the liability side of the balance sheet. It is having the relationship with the liability side of the balance sheet, and further, lower is preferred. For the degree of operating leverage, the lower is preferred, and for the degree of financial leverage, higher is preferred. Okay, so that's the point. Now let's have a look at the particular question over here. We are provided with the data related to the P limited and Q limited. The sales of both is given, the variable cost, contribution, fixed cost, etc. This is given, and we have to calculate the operating leverage of the same, financial leverage, and the combined leverage of the two companies. And we are to comment upon the relative risk position of the same. So this is your homework now. This is your homework now, that you are to calculate all the things for these two companies, right? And the rest we will be covering in the next video. The rest will be covering the next video related to it. Okay, so it's your homework that you have to cover it. And further, do confirm. If you're having any doubts, do let me know in the comment section, and make sure to like this video and further share this video. And for you, we are having a particular website where you can get the study plan. That's basically now available. That is live, where you can get the study plan, and that's easier to access. You can get to know that what particular topics are to be covered. Let's say you are having the exam on the 31st of the May now, right? So in that scenario, you can be like easily be learning that what topics are to be studied for the particular subject. And for that case, you need not to like concern anyone. You just simply go for the particular link that I'm sharing with you. Just follow this particular link I've already shared in the chat box, right? And further, you can start your preparations right away. Okay. After that, it's about the chapter number 9. It's about the chapter number 9, which is related to the capital investment decisions. From the module B, it's the chapter, it's the third chapter that's about the capital investment decisions. Right, so the chapter number 8 is all we have covered so far, and now it's the chapter number 9. So let's start the chapter. It's about the capital investment decisions, chapter number 9 from the module B of the ABFM. So what is basically the capital investment? So capital investment is like that when you are acquiring or creating the long-term physical or productive assets, right? So that's a capital investment. Let's say we do purchase a machinery or some real asset, or let's say technology asset, software or computer or infrastructure. Why we do basically purchase that particular asset? For achieving the future growth, for the expansion purposes, for increasing the efficiency, for the profitability purposes. So that is basically what that is a capital investment. And the type of investment could be like land, it could be related to real estate, land, building, etc. It could be like assets under development. It could be the assets under development, like construction of self-developed assets could be there. It could be related to the furniture fixtures, like office furniture, interiors, machines, production equipment and machines, software and computing, devices like ERP systems, IT infrastructure, etc. So these are your capital investments. And what is the objective of the capital investment? We want to increase the wealth of the shareholders, that wealth maximization. We want to enhance the value of the company for improving the company valuation. We want to do it for the business expansion purposes, like we want to increase the production or the operational capacity, and further also for the efficiency improvement, for the strategic growth, right? For that particular purpose, we want to do the capital investment. And estimation of the project cash flows, like project evaluation depends upon what? Estimating the cash inflows and outflows as per the project life. So if you are going to basically look for the project cash flows, what does it indicate? The project evaluation basically depend upon that only. Let's say we undertook some project, we want to know na, that what will be incoming, what will be outgoing for the next 7 years. So let's say what is the initial cash flow, like the initial investment that we have made in the project. So it's just like a timeline, right? It's just a timeline that in year zero, we invested, let's say 2,50,000. We invested 2,50,000. In the year one, we are getting the return of, let's say, 10,000 rupees. In year two, we got the return of 70,000 rupees, 80,000 rupees. So that's about the estimation of the cash flows. So the amount that you'll be getting, that you'll be investing initially, that's the initial cash flow. That's a year at year zero. And operating cash flow is like recurring annual inflows or outflows. So it's not just like that you have invested once and that's done. No, it may be the case that you are to do the further investment for the operation purposes, right? And also you'll be getting the inflows also during the operations. And then it's a terminal cash flow, like the final cash flow at the end of the project life. At the end of the project life. That is basically related to the project cash flows. So you are having the initial cash flow. Let me write over here. So we are having the initial cash flow, and then we are having the operating cash flow, and then we are having the terminal cash flow. Okay. So let's identify the elements of the cash flow. Like I just told you, it's the initial investment that you do. Then the operating inflows, outflows are there, and the terminal cash flows are there. Cash flow means that includes both the inflow as well as the outflows, right? So initial investment is like capital expenditure. It's the net working capital that you require so as to start the particular project. Operating cash flow is like cash inflow, like you are having the sales revenue or service income. Cash outflow is like you have to buy the raw material or you have to pay the salaries, etc. That's a operating cash flows, right? And terminal cash flows would be like they can be also be the incoming value or there could be the outcoming value also, right? So that's dependent. And how to estimate and basis of each such element, how we can be like estimating such thing. First thing, we are to follow the separation principle. We are to follow the separation principle. Like investment decisions should be separated from the financing decisions. Investment is something different, but financing is other thing, right? So asset related cash flows are included into it. Asset related cash flows, but interest and financing charges are not to be included into it. Okay. So when we are talking about the project cash flows, we are not to consider the financing cost into it. We are to exclude that particular part. So the funda is that the investment decision is to be separated from the financing decision. Interest and financing charges are not to be included. The second principle is incremental principle. Only the additional cost and benefits, those are to be considered. If there is additional cost and there is any benefit due, right, due to the particular project, that is to be considered. The third one, it's related to the post-tax cash flow principle or post-tax principle. Like cash flows preferably be estimated after tax, right? So the cash flows after tax are to be considered, not before taxation, right? That's the part. Now let's have a look at the components of the cash flows. Let's have a look at the components of the cash flows. So we are having the fixed capital, like that's related to the land, building, machinery we are paying toward, or the working capital like inventory, receivables, cash. These are the components of it. Equity capital is like the ownership money, the owner's money, ownership, owner's contribution. And there could be the borrowings also, like the long-term loans. Those are also the cash flows. Those are also basically cash flow. You might be borrowing the amount. You may be having the operating inflows or operating outflows, right? Those are to be considered. Those are also to be considered. The outflow for the operations, like you do purchase for or wages or administrative expenses, right? And further, based on that, we should be like having some objective. Like we should be having objective that we are to achieve the break even, like where we'll be earning some profit or something, right? Or we are to like achieve other objectives that we want to get a debt-free status, right? So these are the other objectives. So these are basically the different components of the cash flows. Then after that, it's about the forecasting and its relation to regulation of the capital for short, medium, and long-term period. So first of all, we do require the fixed assets like the land, factory, plant, equipment. Those are basically required, right? And further, for that purpose, the funding which is required, that's a long-term funding, because the capital assets are going to be used for long duration for more than 1 year. So the funding which is required, basically, that's the long-term funding that we do require. And further, the another one is a working capital. Working capital is basically the capital that you require for the day-to-day expenses. Like we have to pay for the raw materials, or let's say we have to take the, we have to basically have the stock of the goods, like, and further we are having the receivables, debtors, etc. So that's basically the working capital requirement is. That's a working capital requirement, and for that case, we do require the short-term loans. We do require the short-term loans, right? And then after that, it's related to the operating cycle and the working capital. Now, operating cycle is what we have already learned, that particular part. That let's say you started with the cash, right? And after that, you purchased the raw material. You basically processed the raw material and you created there was work in process, or and you had the finished goods. You're having the stock of finished goods, and you went it on the market for the sales. Now, when you'll be selling something, it may be the case it either generated the cash readily, right? Or it may be the case that you have sold on credit, that we have sold on credit. Now, that can be the scenario. That can be a different scenario toward it, right? So that's the complete process. That's the complete process. So it started from the cash and it ended on the cash. So it's the operating cycle. It's the operating cycle. And the longer the cycle is, more is the working capital required, right? So this particular cycle is said to be what we say to be the operating cycle. And longer is the operating cycle, length of the operating cycle, longer is the more is the working capital requirement is there, right? So if you're having the credit period allowed, then you'll be having more receivables, right? You'll be having the more receivables. So that's about it. I hope that you have learned about the relationship that for working capital you require what type of loan, and for particular capital assets you do require what type of loan, right? That must be clear to you. Then after that, it's about the cash forecasts. It's about the cash forecast. Cash forecast is basically going to estimate the future cash inflows and outflows, not the fund flow we are talking about. We are talking about the cash flow. What about? We are talking about the cash flow, because the funds might be like, you might be having, let's say, 5 lakh rupees as funds available, but it might not be the case that you have the 5 lakh rupees of the cash available, because you do count the profit on the accrual basis. Like when it is due, you count it as your profit, right? But the cash might not be actually available. So it's about this CFAT. CFAT is actually what, it's a cash flow after tax. It's a CFAAT, that is cash flow after tax. Like let's say you are having some sales, you basically paid for the variable cost. That's a contribution. You're going to fix the fixed cost that is to be contributed, and you will be having the EBT here. That's the EBT, right? Earning before tax. And after that, you will be subtracting the tax, and then you'll be having the PAT, profit after tax. And then we'll be adding up the depreciation. Now you'll be saying depreciation is the a tax, basically an expense. Why we are adding back the depreciation here back? Why we are adding it back? Because depreciation is a non-cash expense. It's a non-cash expense. Now we'll be lending upon the actual cash inflow after tax. That is a CFAT. That's the actual cash inflow after the tax. Right? So let's work upon it. So it says that XYZ Limited is evaluating the purchase of new machinery with a depreciable base of rupees 1 lakh. Expected economic life 4 years, change in earnings before tax and depreciation of 45,000 in 2021, 30,000 in the year 2022, 25,000 in 2023, and rupees 35,000 in year 2024. Assume straight line depreciation under 20% tax rate. Compute the relevant cash flows. We are to compute what? We are to compute the relevant cash flows. Now just think of it. First of all, we have to calculate the annual depreciation. Now, what will be the annual depreciation? It's a straight line depreciation, like the equal depreciation over the time period. So, what is a useful life? It's economic life of 4 years. Total value 1 lakh rupees. So, 1 lakh will be depreciated in 4 years. So, like 25,000 will be depreciating each and every year, right? So, that's the case. And further, now we are having, let's consider for the first year 2021. So we are having the EBIT plus depreciation, because EBIT is nothing given to you, just consider the depreciation over here. So EBIT and depreciation, basically 45,000 we are considering over here, right? Change in earning before tax and depreciation, that's basically given to you. EBT plus depreciation amount, that is already given to you. Like you're already given with this particular amount, right? So that's 45,000 for the year 2021. It is 45,000. And depreciation amount we calculated for each year, that is to be 25,000. So you'll be having the EBT now. EBT would be what? It will be 20,000. 20,000 you are having now. And further the taxation 20% minus 20%. So you are having this EBT. This is EBT. This is the depreciation that we subtracted. And this is the earning before tax. Earning before tax and depreciation amount that is given to you. So here we are having the EBT, and further then we are to separate the tax liability of 20%. 20% over what? 20% of the total like amount is to be calculated. So 20% of EBT is to be calculated. That is 4,000 rupees. That is to be deducted. So that's the tax that we have to deduct. And then you will be having the profit after tax, or EAT we say. That is coming out with 20,000 minus 4,000, that is 16,000 here, right? And then we have to add back the depreciation. We have to add back the depreciation of 25,000, because that's the actual amount that's available to you. So 16,000 plus 25,000, that is 41,000. So that's the 41,000 rupees that's available to you. Clear with it? Right? So that's the whole part. Then after that, it's related to the cost analysis for the projects. The next topic, it's about the cost analysis for the projects. So the project cost means what? That the total expenditure that's basically incurred while you're setting up the project and you're making it operational. So we are talking about the term loan we have to take and the working capital requirement for the same. So like there are the different like elements, there are different components of the project cost. Like we are having the fixed assets. like the land, building, plant, machinery, vehicles, computers, etc. Those are there. And in case of land, if we are considering the land cost, we have to include the purchase cost. We'll be including the purchase cost, plus we'll be adding the stamp duty toward it, right? We'll be adding the legal fees toward it. Whatsoever the development cost is there, that is to be added up. So that all will be included in the and land cost. Then also the installation cost, like the installation expenses that vary from industry to industry purpose, that basically vary from the complexity of the project purposes, and the direct cost that's related to the setting up the business, like expenses that incurred during the construction, which accumulated and capitalized, right? Related to the asset account. Those are basically to be added up. Any other cost like administrative general expenses which incur during the project implementation, those are also to be capitalized, right? Those all also to be included into it. So that's about the cost analysis for the project. Further after that, it's about the analysis of the total cost. It's about the analysis of the total cost. So first thing, it's about the project cost analysis basically is going to evaluate what? It's going to evaluate that whether the total cost incurred in setting up the project, it is justified or not. It is efficient. Is it capable of generating the desired returns or not? So we have to analyze the total project cost. And what this analysis means, first of all, we have to look into, is it justified? Was it required? Like if this cost was required or not. So it is going to examine the technical, financial, operational, and environmental aspect of the investment, right? So first thing we have to look into that whether we are going to like acquire this particular asset, was it necessary? So whether the correct machinery equipment is selected, is it reliable? Like is it having the adequate projection production, right? The necessity is to be looked into. The second thing, it's about the best combination of the resources. Like many production processes do have the alternative methods also. So we have to look at the criteria, like the cost efficiency should be there, like the lowest cost per unit should be there. We should be looking at that the particular asset is having the maximum output, the best technology, scalable technology, and very lower maintenance. We have to look at the best combination because alternatives are also always present. We have to look the best combination of the same. So first thing, it's about the necessity, that was it required that we are to have the particular uh, asset. And the second thing, it's about the best combination. Third, it's about the competitive bargaining. Competitive bargaining. So the price should be best negotiated. You have to look at the vendor competition also, better quality and services. You have to look for the transparent procurement, like you should be avoiding the overpricing, right? So that should be looked into. The fourth thing, it's about the cost versus recoverable duties, like the taxes and duties paid on the assets. Those may be recoverable through the ITC, like through the input tax credit that may be available. So ITC basically allows the businesses so as to adjust the taxes paid on the purchases against the taxes payable on sales, right? So that's basically the cost versus the recoverable duties. The fifth one, it's about the leveraging, like the financing structure should maintain an optimum balance between the equity and debt. It's not like that you have to pay, you have to basically pay the full amount. Let's say I'm going out to buy a car. It's not necessarily that I'm to like pay in cash, right? I can take some debt, right? Like I can take some debt. So leverage must be looked into. The benefit with the equity is that there is no fixed obligation that you have to pay the installment, and the debt is basically having the lower cost, but definitely that increases the risk. So if you do increase the leverage, like 90% of the amount is financed and 10% is my own, that's my equity. So that will basically increase the financial risk, because if you're not having the sufficient cash flows, the overall business risk, the financial risk is increased. And also the lifespan of the particular asset is also to be looked into. The productive asset, The economic life is very much critical, because if the lifespan is too long, the technology might become obsolete over the time, and the higher repair cost might be there. If the lifespan is too short, then the frequent replacement might be there, because let's say if the particular asset can be utilized just for 2 years, for every 2 years I'm to replace the particular asset. So higher capital requirement will be there for every single time, right? So it's about the lifespan. And the seventh one, it's about the environmental impact. It's about the environmental impact. Like the project analysis is to consider the environmental consequences also, like air pollution, water pollution, power consumption, employee safety. Those all points are to be looked into. And the company definitely should be investing the money for pollution control equipment, for green technology, like for sustainable operations, for waste treatment systems, right? So the environmental impact is also to be looked into. And the eighth one, it's about the growth considerations. Growth considerations. Like for the future expansion, whatsoever the project cost is, it that should also be looked into. Like short-term expansion, additional working capacity must be required. And for long-term expansion, scalable infrastructure is required. So this basically avoids future reconstruction or replacement cost. So growth considerations are also to be looked into. And further, the ninth one, it's about the returns that are projected, expected returns. So the project must be generating the adequate returns. Like we have to consider the risk level that we are taking. So higher the risk, higher the returns should be there. It should also be considered the level of capital that we are investing or the project duration. So the long-term projects must need to like have the sustainable returns. Okay. So these are the various points related to the analysis of the total cost. So the first thing, the necessity is there or not, the best combination of the technology and everything, the competitive bargaining, negotiating the price and everything, cost versus the recoverable duties, like if ITC is available to you, leveraging the composition of debt and equity. The lifespan is very much important, not too long, not too short. And environmental impact is also to be looked into. The company must be investing into those particular devices and treatment plants. Growth considerations, like for cost analysis, should also be looking into the future growth for long term and short term. The return that is basically projected, expected return, those are to be looked into, right? So these are the different points that those must be considered. Those must be considered. So that will be all related to this video. So rate it out of 10. It's really going to motivate us if you basically do like this video. And if you really like the video, make sure to share this video and do follow the link that I have shared with you in the chat box, from where you can get the study plan for your upcoming exam, and do give me a feedback related to it. So that will be all. Thank you so much and see you again in the next video.